Okay, this slide continue from where we stopped from the last slide. So disadvantages of non-proportional treaty. So there are three disadvantages of non-proportional treaty. So let's discuss one by one. Number one, small claims fully fall on net account of the insurer. What does it mean? Small claims or claim which is not more than deductible fall 100% or retained by the insurer. If claims are more than the level of deductible, then only the reinsurer will get involved in the settlement of claim. Otherwise, if the claim is less than deductible, definitely these claims are borne by the, or are paid, or are retained by the insurer. So this is one disadvantage of non-proportional treaty to the insurer. Number two, very fast or very rapid adjustment in terms of the contract or in terms of the treaty following claim experience. If in one particular year, the claim is very high or many claims occurred within that 1 year, there are going to be adjustment in terms of the premium rate, the rate of premium that the treaty used for the following year, the next year, will change. Meaning that the rate will be becoming more expensive if compared to the current year, if there is more claim occur during the year. So terms will change. And it comes to the rate of excess of loss premium. Number three, no transfer of risk. Non-proportional only provides spread of loss facility. What does that mean? So we know that non-proportional only concern about sharing of claim. There is no sharing of original risk, meaning that there is no transfer of risk between the insurer and the reinsurer. Since there is no sharing of risk, the relationship between the insurer and the reinsurer is short-term. If compared to proportional reinsurer, where insurer and reinsurer are sharing original risk, the relationship between the insurer and the reinsurer are more long-term, which is beneficial to the insurer. Okay, ultimate net losses. An agreement between reinsured or agreement between insurer and the reinsurer, whereby reinsurer agrees to pay all ultimate net losses on per risk basis, which exceeds the insurer retained loss or deductible up to an upper limit fixed by the reinsurer. So you have to remember the amount or the final amount of claim share between the insurer and the reinsurer is actually the components of the final claim is actually made up of so many things. Example, ultimate net loss is the total claim actually paid by the insurance company in their settlement of claims. And this total amount of claim include amounts such as or costs such as claim expenses. Claim expenses are the expenses that the insurer incur where they have to pay to the loss adjuster, to the loss assessor, and other investigators. So this amount will make up claim expenses. Salvage. Salvage is the amount of a certain amount of money which the insurer recovered when they have disposed an item or a subject matter after claim. So insurer is getting money out of salvage. Subrogation, if you can recall back the term subrogation that you have learned previously in part 3, recoveries and other recovery from other treaty reinsurers incurring to the benefit of the excess of loss cover, meaning that the total amount paid by the insurer in the settlement of claim is equal to claim paid to policyholder. Let's say total loss of a car. Let's say the cost of the car when it involved in the accident, let's say 20,000 ringgit. So the claim paid to the policyholder is 20,000 ringgit, which is the cost to replace the car itself, plus expenses of litigation if incurred. Let's say insurer would like to take the case to the court and they have to pay the litigation costs. appointing lawyers, such thing will incur cost, and this will add to the amount of claim paid to the policyholder. Let's say litigation cost is 10,000 ringgit plus other expenses of the reinsured, excluding expenses and salaries of reinsured employee. Or let's say other expenses such as loss adjuster fee, let's say loss adjuster fee is 5,000, so litigation is 10,000, adjuster fee is 5,000, is already 15,000, plus the original claim or the amount of the cost to replace the car is 20,000, so it is already 35,000 ringgit, but they have to deduct any amount of salvages, if there is any, and other recoveries from other insurance company. So ultimate net losses is the final amount of claim share between the insurer and the reinsurer in the settlement of claim. So we have to include so many other costs to the final claim, such as litigation costs, assessor's fee, adjuster fee, and so on, and have to reduce the final claim with salvages. Salvages is the amount of money recovered by the insurer after they dispose an item, and other recoveries from other insurance company. So this is ultimate net loss. You can read it again. Okay, per risk cover. Why it is called per risk? Per risk cover because it covers losses on every individual risk that exceeds the deductible and falling on the business covered under the treaty. So working excess of loss is on per risk basis because it covers each and every loss, each and every risk. How to imagine that? Okay, if you can go back to my example, calculation example, which I've shared in YouTube, you can see that this is deductible. Deductible is the amount that the insurer has to retain for each and every loss. And this is the recovery for each and every risk, or for each and every loss. You can see that the recovery, the amount of cover is 2 million in excess of deductible of 1 million. So you can see that for each loss here, there's gonna be one deductible applicable for each and every loss. This is what they call it, per risk cover. So one deductible for one loss, one deductible for each losses from the same event. So that is why it is called per risk cover, because one loss will apply one deductible. Okay, the term working cover. So this is the name, working excess of loss. And the other excess of loss cover is called catastrophic excess of loss. Why it is called working excess of loss or per risk excess of loss? Working means it refers to the layers. It refers to the layers of the excess of loss. Because the deductible is very low, the amount of deductible is very low, the reinsurer is expected to be involved in paying claims. For each and every claim, if the deductible level is very low, you can expect that the claim will hit the cover. So that is why it is called working, because the layer is working to pay the claim. And it is a good alternative to surplus treaty in providing protection on per risk basis. So this is like an alternative. If the reinsurer doesn't want to use surplus treaty or proportional reinsurance, they can choose working excess, or they can choose per risk excess of loss instead of using surplus reinsurance. The only difference is with surplus reinsurance or proportional reinsurance, they have to share the original gross premium with the reinsurer. Whereas if the insurer is using working excess of loss cover as a protection for per risk losses, they do not have to share the original premium. they can retain the whole original premium, but the only thing is the drawback or the disadvantage of using working excess is that it only involves in the settlement of claim. There is no sharing of original risk.